Welcome to another episode of the Portfolio Fix, a podcast with AAM. This episode is part of a series exploring market outlooks for investment strategies beyond investment grade fixed income. Today, we're going to focus on high yield public corporate debt. My name is Patryk Carwinski. I am a portfolio manager at AAM, and I'm joined today by Kevin Ziets, portfolio manager at Muzinich Co. Muzinich has been a partner to AAM since 2012, helping deliver high yield and private credit strategies to our insurance clients. This recording and other content can be found on our website at www.aamcompany.com. Kevin, welcome. Great to have you.
Thanks for having me, Patrick.
So let's get right to it, Kevin. Returns in U.S. high yield markets exceeded 8% last year. That was great, but what are the themes that you expect to drive returns in 2025?
Last year was a very strong year, 8%. It was pretty much a straight shot. There were a couple of months maybe where we had negative returns, but it was a very steady year. I don't think we're going to have a year like that. We're actually, but I'm so far being proven wrong. We're up close to 2% year to date. So, but I do think there's more scope for some volatility, and I think that the themes that are gonna drive returns are likely to be the ones that are talked about every day. It's going to be about policy changes, what impact that has on growth, and what impact that has on inflation. I think those are big themes, and I think companies that are more domestically focused versus ones that are global are likely to be the winners. I think from a sector perspective, at least as it relates to high yield, there's been a big theme. There was a big theme last year. I think they'll continue into this year in telecommunications. Companies that are ahead of the curve on converting from legacy wireline to fiber are going to be the better performers. And there's a convergence in product, quite frankly, between you saw the Verizon and Frontier merger, and I think that kind of convergence of wireless and is going to be a real theme for this year going forward. Another thing we're mindful of is stabilization that's starting to show itself in the commercial real estate market. I think that is a key driver of potential returns. And then lastly, although it's probably, maybe I should have mentioned it first, I think M&A is going to be really important because we still have a convex asset class, and asset class that's trading below par. And, those instances where companies are getting taken out or merging with higher quality companies can be a real driver of returns. We saw that with Calpine getting an announcement of their merger earlier this year. And then on the flip side, companies that are more aggressive in buying within high yield, could see some pressure on their bonds. So those are the themes that we're really looking out for.
Thanks. Lots of moving parts. I'll certainly have you expand on some of those points as we get our conversation going.
Great.
But maybe I'll go back to just thinking about where we started the year off. Obviously, some of the performance that we saw was driven by tightening in spreads, and they are at very tight levels. High yield bond spreads are at about 270. Where do you expect spreads to go from there? Can they go tighter?
Well, we may be basing it off of different indices, but I'll say we saw the year started about 310, and it did get down to the levels that you're talking about. Spreads have widened in February, so we're now back to about 10 basis points of net tightening year to date. More of the return is, as seems to be the case a lot in the last few years, is being driven by what's happening in rates. And particularly in the last, I'd say month and a half, rate tightening has been key. I think that spreads are tight. We like to say that they're justified to be as tight as they are because of the fundamentals in the market. We can definitely get into that. But I'll also say that spreads for a large part of the last year, they've kind of solved for yield. So I think for the first 9 months, call it, of 2024, spread just moved so that the yield stayed in kind of a 7.5 to 8% range. When it broke above 8, the buyers really came into the market. And when it got underneath that, you saw some modest sell-off. Going into and coming out of the election, that range seems to have moved to about 7 to 7.5. And so I would say it's more about the yield than it is necessarily about focusing too much on the spread. At that yield, you can really withstand a lot of volatility and still have positive returns. If we look back to 2010, and if any quarter that started with yields over 7%, the next 12 months had positive returns, and in most cases, it was 5% to 10%. So we still think we're in a range where we should expect positive returns, barring a sharp change in the macro.
So do you think investors looking for an entry point or to add or enter the asset class should be focused more on absolute yields than maybe a possibility of spread widening in the sector?
I think that's right. I think that if we were to break above 7.5%, I think you'd see demand really pick up. We kind of saw that in December. December was a weaker month, and yields got back into that mid 7% range, and then January was sort of back to the races. So I think we're probably towards the lower end of the range, but it wouldn't surprise me if we had a small correction.
Understood. Thanks for that. Maybe I'll shift a little bit to get into some of the things you talked about at the very beginning. And obviously, I have to go here because there's a lot of discussion about President Trump's policies and the expectation that they're going to have an outsized impact on markets.
Right.
So maybe if you could talk about, when thinking about tariffs, immigration, deregulation, taxation, government spending, what are some of the risks and maybe even opportunities that you see for the asset class arising from these policy initiatives?
Yeah, it's a great question, and the one that comes up the most in these types of meetings, and conversations. So, the very high level answer is that high yield is predominantly domestic in terms of demand and in terms of supply. Look at some of the largest sectors, whether it's TMT, energy, healthcare. They're really domestic. These are really domestic businesses that won't have an outsized impact from tariffs. Where there is concern, autos comes up a lot for sure. Think of aerospace and defense particularly if you think around government spending, and basic industries. So chemicals, metals, things of that nature that are driven more by global demand. But those are relatively small sectors. Autos, for example, is only about 2.5% of the high yield market. It's a very similar number for aerospace. Chemicals is a little bit bigger, but there are within each of these sectors, there are companies that are more domestically focused than not. And so you can't paint, one brush. I guess I'd add retail into that. There certainly are pockets of retail, that are big importers, but there are many retailers that where it's not a major impact. So I'd say for me, tariffs is it's more of a macro concern than it is a high yield concern. It's what does that do to inflation and obviously rates and consumer demand. But it's not an issue that I'm overly concerned about for high yield companies. Where I think there is more legitimate concern, and what we're really scrutinizing our portfolios, is in healthcare. Healthcare, it's a large sector in high yield. There is talk of really significant cuts to Medicare and Medicaid. They're an important payer, in some cases, a majority payer for some of the companies. And so we have to be really careful on where we're invested. But I'll say with all of these things, there are risks, but they also could create opportunities. If you get a really high quality company that, maybe is going to see some pain from policy actions, but is trading as if it's, far more stress. We want to keep the flexibility to add in those situations, because we think the market's likely to overshoot just as much as it is to get it right. That's definitely something we're mindful of. On the opportunity side, I would think of deregulation focused sectors. Financials comes to mind. Financials become a relatively big portion of the high yield market, and I think they're a big beneficiary of deregulation. Any kind of industry that could benefit from M&A that might otherwise have been blocked under the previous administration could be a beneficiary. So the broadcasters are one that comes to mind. We have to tread lightly because there are secular concerns in that space, but but there are some spots to pick. And maybe an area like utilities where, if there's less subsidies being given to renewable energy, then we're seeing really strong pricing power for and capacity constraints for utilities, and that's an area that we definitely have are harvesting.
Thanks for that, Kevin. Then one of the things that maybe I want to shift to is we're constantly evaluating attractiveness between high yield bonds that you invest in, and
Right.
then syndicated bank loans, which are floating in nature, and just thinking about some of these impacts, and particularly maybe the Fed slowing its pace of easing and thoughts about inflation. Any opinion about the relative attractiveness between fixed income and floating rate assets within the portfolios that you're managing?
Yeah, it's a good question as well. The last year the market was expecting 8 cuts at the beginning of the year. That was to me a real opportunity to get to maximize exposure to loans and achieve that carry. Right now the market is pricing in 2 cuts and another cut in 2026. So the carry differential is not that substantial. The spread differential, I think, is about 100 basis points. And we are seeing a difference. For a long time, we've seen a difference in credit quality between loans and bonds. Loans have become really a majority single B space, and bonds have migrated to a majority double B space. But that's actually playing out in default rate differentials. And so it's something to be mindful. I would say we're at 100 basis point spread. We definitely are selectively adding to loans, but it's not a max exposure as it was a year ago. I think if we got out to about 150 basis points, or the market started pricing in a lot more rate cuts than we were expecting, then that could be another reason to take up the exposure. But at this point, it's more based on credit and getting exposure to names that we like that we can't otherwise find in bonds.
Okay. So kind of expectations of inflation will be a bit of a driver in terms of
Huge.
what you do that.
Yeah.
Okay. And then, what about issuance? What do you expect for the remainder of the year? And then do you expect investor demand to just be as robust as it's been?
Yeah, I do. Last year we had close to $300 billion of issuance, and it was 75%, 76% refinancing oriented. So it wasn't a lot of net new supply. And it's just, we've been in a technically tight market because of a lack of net supply, while there's plenty of demand for the asset class given the elevated yields. And I expect that this year we'll see our expectation this year was that we'd see a little bit more supply and a good bit more net supply, maybe a dialing down of refinancing, just because so much refinancing activity has already occurred. It's not necessarily playing out that way yet. We've seen about $40 billion of issuance year to date in the high yield market. So a little bit below the pace that I would have expected. That could be partly due to companies needing to get cleansed from filing their year end financials. Could be some of the uncertainties that are out there in terms of inflation and policy. But I suspect that the demand side is still there. The technical shortage of supply is still real. and I think that the demand, the supply will rise to the occasion to meet that demand. So we're expecting another year of pretty solid issuance.
You mentioned that part of that demand is the understanding of how strong fundamentals are within the asset class.
Yeah.
So, when we first started along this inflationary cycle, there was a lot of concern about the increased c- carrying costs of debt for high yield borrowers. Is that concern over higher for longer kind of behind us?
I think it's behind us, and that's potentially I'll eat those words, but I think it's behind us. We certainly have started down a rate cut path, so the base rate lowering will help on floating rate exposures, and also the refinancing activity in loans is miles greater impact than what we've seen in high yield, and that's a 25 to 50 basis point drop in the spread each time they refinance. I think roughly 100% of the loan market repriced last year, and we're off to another really strong start in that regard. I think there's been $250 billion of issuance year to date in the loan market, and again, 90%, 85 to 90% repricing or refinancing oriented. So it's definitely we've come off of the incredible coverage levels, interest coverage levels that we had when rates were super low, but I think we're still in kind of a high fours type of interest coverage, which historically speaking is amazing, and I expect that we will start to level out rather than continue to drop. So that's very encouraging for high yield fundamentals. That the rating migration I mentioned earlier is also really important. We're up to about 55% double Bs in our market, and there's just not much in the way of defaults. We're at a 0.3% actual default rate with a maturity wall that is very, very double B heavy and not that large in the absolute.
Well, maybe that'll take me to one of my final questions for you is, what metrics do you view as important to watch as indicators of, total return potential in the high yield space for the year?
Yeah, I mean, I think inflation is key because it's so determinant on where rates and rate expectations are going. We saw a bit of a surprise on the CPI number this month, but I think that may have been a little bit overstated by the owner's equivalent rent, and I think otherwise, I'm not saying that inflation isn't a problem, but I just whether we're spiking in inflation, I guess I'm a little bit of a skeptic on that. But that inflation is really important. I think employment and wage data is really key. Everything around the consumer, whether it's consumer spending, consumer credit, and charge-offs and delinquency rates, those are very important. In high yield, always energy prices. We're mindful of the desire for more production by the government, whether that actually plays out, or I would say also skeptical about, but certainly things like resolving the conflict in Ukraine could go a long way just to keeping energy prices under control. And then I mentioned this before, but I think commercial real estate prices are also key. I think they're good. They're sort of a good gauge for the health of the financial system.
Great. So similar things to watch is we're paying attention on the investment grade part of the fixed income markets. Great. I appreciate that. Well, I have a last question for you. It's not
Yes.
investment related, but I'm in Chicago and you're in New York City, so I have to ask you, do you like deep dish pizza?
Do it. Well, I went to school in Chicago, so I like deep dish pizza, but it doesn't like my belly very much or my waistline. So I probably migrated more to the thin crust.
Well, spoken like a former Midwesterner.
That's right.
Well, this has been a great conversation. Again, I'm Patryk Carwinski with AAM, and it has been a pleasure speaking with Kevin Ziets of Muzinich Co. Thank you, Kevin.
Thanks, Patrick. Talk to you soon.
And thank you to our listeners for tuning in. This has been The Portfolio Fix, a podcast with AAM.